Hi, everyone. Welcome to this interview on climate science and investment decisions. My name is Mathieu Favas. I'm the Economist Finance correspondent. And I'm delighted to be joined by Wendy Cromwell, the Vice Chair and Head of Sustainable Investment of Wellington Management. Welcome, Wendy.
Thank you for having me.
It's a pleasure. So we've been hearing and discussing about the risk climate change poses to many constituencies, from populations to companies, and also slightly more recently, perhaps, to investors' portfolios. And that raises a quick question that I hope we'll discuss today in the interview, which is how to assess that risk. How should climate insights inform investment decisions concretely? What can companies do to reassure investors about those risks? And what about performance and the broader impact to capital markets? So perhaps, Wendy, to start, I'd like to ask you about the role climate science plays in your investment decisions, perhaps in concrete terms. So could you describe to us a bit the sequence of actions, that is to say, when those climate science intervenes in your decision-making process? What weighting do you give to it? Who is involved internally? Just for us to get an appreciation of how this concretely plays out.
Sure thing. Let me just give you a little bit of background on how we got into investigating climate science as part of our investment decision-making process. Back in 2018, we looked out into the marketplace and we saw that there was a lot of focus on transition risk, appropriately so, but less focus on physical climate risk, things like heat, drought, wildfire, hurricanes, floods, access to water, air quality, sea level rise, and the effect on capital markets. And so we wanted to study that and those influences to see if they were going to matter to the holdings that we hold on behalf of clients. To do so, we launched a climate science partnership with Woodwell Climate Research Center, again, to bridge the gap between climate science and finance. And the gap was huge. It still remains pretty large, but it is closing. I tell this quick story just to be emblematic of this gap. When we sat down with Phil Duffy, the head of Woodwell Climate Research Center, we said we wanted to understand those variables, heat, drought, wildfire, et cetera, in basis points. And Phil's a brilliant climate scientist, but he looked back at us and said, what's a basis point? So obviously, investors think basis points, climate scientists think RCP scenarios. We needed to bridge that gap. And ever since that point, we've been trying to build that knowledge base together, where Woodwell helps us create granular grid maps of the influence of these various variables over different time horizons. We overlay those grid maps with capital markets information to better understand which of the securities we own are going to be most implicated. And then in the decision-making process, we can decide to not own a security that's priced similarly to one that doesn't have that same level of risk, or we can assess the risk that we see in the security and decide that it's already accurately priced and continue to own it. And that runs right through our investment process across multiple asset classes.
That's fascinating, and I'm enticed to ask then, in terms of gaps, what were the biggest surprises? What were the asset classes that were most impacted that perhaps you did not expect would be? And conversely, what were the ones that were proven more resilient?
It's a great question. And you know what, you're getting at this idea that physical climate risks don't impact all securities equally. And I think it is important to highlight that and to focus in on the ones where there is the most risk based on their locational properties. And what we found was securities that where the value is dependent on a physical location in some way, shape, or form, those were the ones that were most likely to be implicated. And then you have to think about where those locations are and whether or not they'll be implicated and whether or not it's in the price. So, for example, if you think about physical locations, municipal bonds are inherently physical in terms of what they're funding. They're locational securities. They tend to have a long time horizon to them. So we can look at various municipal bonds and the projects that they're financing and see if those projects are going to be implicated by climate change and whether or not that's priced. And you can do that by using these maps. And some areas are more likely to be implicated by climate change and others are not. you often find similar pricing because the market isn't looking at those securities in this way. So we'd rather own the securities that are not going to be implicated than the ones that are for the same price.
Are there instances where perhaps it's not as clear cut? Because I imagine when you compare two securities that one of them is not implicated or not impacted, the other one is, then the decision, I guess, is made easier for you. But when the source of the impact is perhaps different and the impact is similar, how do you make that decision then? How do you choose between the two?
Yeah, I think the analysis doesn't always result in us not buying a security. In fact, sometimes we evaluate the physical risks and we do buy the security. So for example, we were looking at a company that produces wind farms in Asia and in the United States. And we were able to engage with that company management team and look at their locational data to determine whether or not we thought that they would be facing higher wind speeds, hurricane like wind speeds that would be disruptive to the wind farms that they were producing and therefore disruptive to value. And we ultimately determined, or we don't believe that that will be the case, and so we were able to make that investment anyway. On the other hand, we were looking at a company who had just built a pretty significant plant on the southern coast of the United States. And looking at our data and also looking at FEMA data, we discovered that that significant investment was in a floodplain, which doesn't necessarily mean that you shouldn't invest because maybe they've taken some measures to make that property more resilient. But when we engaged with the management team and we asked them about how they thought about that risk, it was clear to us that they weren't considering the physical risk of climate change in their location assessment. And so that made us uncomfortable with that security. So it is a bit of art and science. It's not precise, like this one has climate risk, don't invest, this one doesn't. Do invest. It's sometimes engaging with the management teams to understand if we've got the locational data correct, if they've already built in resilience measures, how they've thought about it, and that gives you insight into the company as well.
And so these maps, are there a resource that anyone within the firm can turn to make decisions, or do you have a specific team or department dedicated to it? How does it work internally?
Yes, it's a desktop tool that's available to all investors to plot their holdings or potential holdings and do that analysis. But also, our climate team helps with that analysis through these we call them climate portfolio reviews, CPRs, in order to help the teams identify where the risks are most acute and dig in more deeply.
What other sources apart from the maps do you use to make these decisions?
Well, we use the CDP database of disclosures because one of the things that's really useful is to not only understand where the risks lie, but understand whether or not the company has already disclosed them. CDP can also be useful in actually looking at the company's own filings to identify potential opportunities because there's certainly risk associated with physical climate risk. And there's also opportunities to create products and services that are going to help economies and society adapt, which would be more in the opportunity category. And sometimes we can find whether or not a company has identified that as an opportunity for themselves and their products by looking at their own filings. And sometimes we don't see that, and we can lean in and ask the company how they're thinking about that market opportunity.
And of course, all this analysis using the various tools that you have doesn't apply only to new investments, right? It also applies to existing investments. How much have you had to reshape your portfolio to take into account these new insights that you have on climate?
So we manage about 1.4 trillion in assets for clients across a wide variety of asset classes, from equities to municipal securities, private securities, and hedge funds. And the extent to which climate risk assessment is integrated into each portfolio is somewhat variable, dependent upon the time horizon of the investment strategy and the amount of influence the physical climate risk have on the portfolio securities that are held. But that said, yes, that you asked was, it's not only for new investments, it was for old investments. That was our original intent. Our original intent was to bring this into our research process in order to help us achieve our existing investment objectives for clients. As we did more and more research, we realized how compelling it was. And as we exposed our clients to it, they also asked about new products that they could buy that were directly linked to the Woodwell research. And now we also have a whole climate platform based on the back of this Woodwell partnership. So that's been productive as well. But the original intent was to shore up our existing portfolios and make sure we were doing a great job in those.
Which makes me think, actually, and one of your earlier answers also alluded to that. You spoke of disclosure, but what companies, investing companies, what can they do to reassure investors? What sort of signals can they send? Information can they release?
Well, we've talked primarily today about physical climate risks, but obviously transition risks are increasingly important as well and present as well. And so we think companies should address both. In fact, we've been in the US pretty engaged with the SEC as they've been exploring mandatory climate disclosures for companies. And we've submitted a public letter asking them to ask companies to share their scope 1, scope 2, scope 3 data, their locational data, and to harmonize anything that they do in the US with other practices that are emerging globally so that we can all exist within a global standard. And they're working on that. But we find that investors are using this data to make better investment decisions. And we'd rather them get the data from the companies themselves rather than from an estimation process from a vendor. So to make better decisions, more accurate decisions, it'd be great to have the companies reporting that information. It was surprising to me when we started working on climate science that locational data actually isn't that easy to find with regard to where companies are located, where their suppliers are located, et cetera. So even just disclosing where you have physical locations as a company could be beneficial to this practice.
That's interesting. And are you satisfied overall by the quality of the data you're getting for this analysis? Or is there much margin for improvement?
There's a lot of margin for improvement. That's again why we're engaged with our key regulator, who is thinking about what issuers can and should be doing to help capital markets become more efficient. To say, if the companies were disclosing their own scope 1, scope 2, scope 3 data, we think investors would be better off. We think asset owners would be better off. And we actually think the companies themselves would be better off because they'd be better able to manage their own data, provide the most accurate data to the marketplace, potentially change practices if needed to align with a low carbon transition.
And I guess investors in the audience, but I suppose other people too, will be interested to hear about the impact on performance that this all means. So I'd be curious to ask you a question with several questions in it, actually, which is, what impact do you think climate trends is going to have on investment returns overall for across capital markets, for your own portfolios, that of your clients, and what differential can having the tools that you have make to performance between having them and not having them, for example? Do you have a sense of that?
Yeah, I think it's really critical. Some people take that question and they say, if I consider climate, how is that going to be a detriment to my returns? And I would actually flip that on its head and say, if you're not considering climate, it's going to be detrimental to your returns because you're not considering a key factor, a systemic risk, and a major change in capital markets. So if you think about major trends that investors have invested in the past, you want to ensure that your companies are aligning with that trend, with that theme, in order to take advantage of it or avoid any risks that come from it. Same thing with climate. So I really do believe that you have to be considering climate in order to invest these days. One of the things that we've figured out, we made a net zero, we're part of the Net Zero Asset Managers Initiative. We were a founding member. I'm on the advisory group. And the reason that we made that commitment was because it became obvious to us through our physical climate risk research that physical risks are happening within an investable time frame, and that they will increase in severity and intensity and frequency. Um, that means that the transition that's already underway, the low carbon transition, will continue to unfold as the market becomes more and more aware of the necessity to transition. That gave us greater confidence that the companies that we invest in, the good ones, are going to have a plan for this major transition. And those that don't probably aren't going to be worthy of investment over a longer time horizon. So we think this is all value additive to portfolios rather than detrimental. Increasingly, we've been asked by clients to do more strategic capital allocation or asset allocation work, come up with estimates of how macroeconomically it's going to affect GDP. That's work that's in progress. It certainly is variable across countries. I think it's imprecise to do that work, but we're doing it anyway. Where we have the greatest confidence is looking locationally bottom up at each of the securities that we could potentially invest in and understanding those at a granular level. Now rolling that up into something more macro to give investors a better assessment from an SAA standpoint is also work in progress.
Great. Well, this is a really big slate of work for you guys to work on. And I look forward to, I hope, hearing about some of the results that you come up with. Wendy, thank you very much for joining us today. This is all we have time for, unfortunately, but this has been fascinating. So thanks very much for your insights. Thank you very much to you all for listening in. Please stay tuned for the next session, which we start in a few minutes.